that's the bio summary, so feel free to read that when you're really bored. I am just really excited to be here with you today and visiting with you on some of the basics on reshaping the charitable gift box and kind of thinking about some of the charitable giving and philanthropic planning that takes place and what some of the vehicles may be that donors could potentially use to provide that charitable benefit to your organizations. In looking at today's registration, I know we do have some donors on the line as well as, but I think the vast majority of our attendees today are charitable organizations who work closely with the donors and their charitable giving. This slide here shows the learning objectives that we have for today. It is a basic level class, so we won't be getting into any details on any of the in-depth technical details on the charitable planning techniques. Otherwise, I would get on a roll and we would be here until the end of the day. And I know you all have busy days ahead of you, so I appreciate your time that you are taking today, and hopefully that you do find value in the next hour that we are together. The learning objectives that are here, I'm going to tip them on their head just a little bit, and we're going to visit quickly about, actually, we have a first polling question. So what I was going to say is we're going to visit about the 8283 first. So if Amy wants to launch our first polling question. Okay, and the results is the correct answer for that polling question is actually false. So we'll visit a little bit about that. The key is in that question is all non-cash gifts. So there are certain non-cash gifts that are exempt from the signature filing requirement of charitable organizations, and we will look at those in just a minute. All right, so what is the organization's responsibility? And the reason I put this section first is this is the technical section, and then we can get on to the fun stuff. So you should all be familiar with the 8283. It's for non-cash contributions, generally the form that donors need to have completed and attached to their tax return for gifts of non-cash items. There is a filing requirement for certain items of even $500. So that there is elements of the 8283 that the donor needs to complete. So they need to be thinking about that depending on their gift, and if it's even over $500, what parts of that do they need to be completing. But charitable organizations, so here's the 8283 is filed by individuals, partnerships, corporations to report the non-cash contributions. There's a variety of returns that it needs to be attached to. Report non-cash contributions totaling more than, but so Section A of the 8283 is for non-cash contributions totaling more than 500, but $5,000 or less, and publicly traded securities. So if it is a publicly traded security, this is one of the exceptions where charitable organizations do not have to sign the 8283, is if the donor is giving publicly traded securities, the donor only completes Section A of the 8283. There is no donor or donee or charitable organization substantiation required for that gift. Section B is where that charitable organization substantiation comes in. And there's just a little bit more on the Section A. And there's going to be a lot of slides today. There's a lot of extra information in the slides. I've put it in here for reference, for your reference, but certainly in about 55 minutes or so in a presentation, we don't have time to go through all of these things in detail, because I could probably spend an hour just talking about the 8283. So the 8283 Section B is required for non-cash contributions, excluding publicly traded securities that are valued greater than $5,000. And there's some qualified appraisal requirements, but it should be up to the donor and their tax advisor to be able to go through and visit about what the completion requirements are for that form, because it is part of their tax reporting. So from the charitable organization's perspective, it's this section here highlighted it, so it's in section B at the very bottom of the form, that's the only section that you as a charitable organization should be completing. You should, couple words of warning, don't complete a blank 8283. If you have a donor who gives you a blank form and says, well, they'll fill in the rest of the information later, I would highly advise you not to do that, because you don't know what if they haven't filled in the gift information, you don't know as a representative of the organization what you are acknowledging. So it is up to the donor to have filled in the information about the gift, or have someone help them fill that in. So very basic information that you as a charitable organization needs to acknowledge when completing the 8283s. So that's pretty much what I wanted to talk about on that form today, just because it is tax season, and you're probably seeing more of these come through as your larger donors are completing their gifts and asking for the substantiation on those. The other thing that so I mentioned not to complete uh, a blank 8283. Also, do not provide a value. That's not only on the 8283, but also on just your charitable substantiation. You are not a qualified appraiser, and so that is something that you may need to value it for your own financial reporting purposes, but as far as value of the charitable donation, that is not something that you should be doing, because there's a lot of technical rules as far as how even certain non-cash items should be valued. Is it based on fair market value? Is it based on cost? It's there's a whole gamut of rules that dictate what the value of a charitable gift is, other than cash. So certainly that is not something that you should have to be doing, or that you should be doing. And that's just a blown up view of your donee acknowledgement section. So you can take, there's very, very little information in there that that is gift specific. So charitable gift planning, and thinking about um, gifts that are outside of cash. There are various reasons why a donor wants to give a charitable gift besides just the tax deduction. That was the concern a few years ago when the Tax Cuts and Jobs Act was raised the standard deduction, and we were worried about whether or not people would continue to make charitable gifts. And there's a lot of drivers that why people will continue to do good, and especially in today's times. I mean, we're seeing that. I will mention it hasn't passed. It passed the Senate last night, but it has not passed the House. The House is set to vote on the CARES Act as of this afternoon. So hopefully that goes through. But there are a couple charitable giving provisions in the CARES Act. One would temporarily eliminate the adjusted gross income limitation on charitable gifts. And the other is a partial above the line $300 deduction for charitable giving for people who do not otherwise itemize. And they included those provisions in the CARES Act as hopefully incentivizing people to give to charitable organizations in this time when a lot of people are struggling to make ends meet, and there's just a lot of organizations that are pulling together and helping their neighbors. But that way, people who have the fiscal ability to give, they're giving them some additional incentives to do that. So it's not in the slides because it was a late breaking, and it's not official yet because until the House votes on it, but they were hoping they could have passed it by unanimous consent. But there's a few representatives who have come out and said that they would not vote for it. So we'll see, but the House is assuming that it'll pass. There's also some provisions in there on qualified qualified charitable distributions, and we'll talk about that when we get to that slide. But so people will continue, whether it is your development, and when I said your charitable development offices, so the people who are giving your current gifts, or if it's your plan giving departments, the people who are looking at long-term giving. There's people will give for reasons other than just to get that tax deduction. But on the other side, there's people who do their estate planning to involve charitable giving, that they're that the charitable deduction actually may be minimized. So they're doing it for estate planning purposes. They're doing it for wealth transfer. And some of it might be for income management. And one of the most commonly recognized non-cash charitable gifts, and we say non-cash because it's a current gift, but it's not a writing a check gift, is the qualified charitable distributions. And there's incentive for people to make those gifts because that type of a distribution from a traditional IRA is not includable in their taxable income for that year up to $100,000. So those are a couple ways where they can manage their income too. Or if they're going to use a charitable contribution to offset some capital gain that they've got, it might be other reasons why they are looking to make that gift. But whatever their reasons are, when you are working with your donors, make sure that you're listening to them. Understanding what their charitable goals are. You have your goals, you have your needs. If you've got continuing operating needs, you've got maybe a specific program that needs to be funded, maybe you've got a building that needs to be built, but that might not necessarily line up with what your donors' goals are. And so make sure that you're listening to them and understanding how you can accomplish both goals, the organization's goals as well as what the donor's goals are. If you're looking at plan giving, how involved does the donor, or do they want, or their donor's family, how involved do they want to be in future administration of that gift? Do they want to see the fruits of their donation now? So do they want to see their name on that new building, or do they want this to transfer? Do they want their gifts to transfer after they've passed, and they're that quiet donor, the ones that a lot of us are really thankful for, because they give often, they give a lot, and they're not the ones that necessarily want their name on the building. Do they want to financially support family members? So those are some of the split interest gifts that we're going to be looking at. Understanding what their cash flow needs are. That's important. Can they afford to give the gift? Based on how old they are and what their other cash flow in is, what they're expected to have to pay if they've have other expenses that they're, and what are their asset holdings that could be good options for charitable giving. Those are all things that you need to be listening to when you're talking to your donors. It's also important for giving to include more than just the plan giving or the development team and the donor. Make sure they're talking to their tax advisor or their attorney if their attorney is knowledgeable in tax items. If they're a tax attorney, then that would be a good advisor. But the biggest thing is the simplest non-cash gift can have adverse tax consequences. You might think that the donor may think that it's a good gift. For example, if they inadvertently gave a security, a publicly traded security that they'd held for short term rather than long term. So if they'd held it less than 12 months and they donated that asset, well, that's limited to the basis in that asset, not to the fair market value of that asset. So there's various things that can go wrong in gifting. So, or it's also thinking about, are there gifts that they could be giving in their, when they're looking at their entire portfolio, and what they want to go to their family and what they want to go to you as the charity, which gifts are more tax advantageous to gift to you as the charity? So if you're going to transfer $1 million to the charity and $1 million to your son or daughter, which ones are the most advantageous to give to the charity versus to the child? Making sure that those discussions are had as well. So that's why when I say convening the team, it's important that they do have their tax advisor included in those discussions, just because what makes sense from all situations, not just from the charitable gift perspective, but thinking long term as well. Lots of opportunities in non-cash charitable gifts, because while 90% of the contributions are made in the form of cash, this is an old statistic. I can't tell you based on where the markets are at today, but as of when this study was done a couple of years ago, this was actually released, the information was released in 2019, but it takes a while for the government to gather information. Less than 1% of the US wealth was held in currency or checkable deposits. So where do we look for a lot of non-cash gifts, or a lot of charitable contributions? Would be to the non-cash gifts. So we have polling question number 2. And that was more just an informational for me, just to kind of see how, where the audience was at, as far as if you do have an internal development staff. So I thank you for your response. Operator error. So anyway, I have my slides printed, and I was reading across instead of down. So yeah, like I said, it's operator issue. So this is just a summary slide of what I would say are the most common non-cash contributions. While we know that there's ones that are much more high on the list of common, these are the ones when we look at from a plan giving perspective, these are the ones that are the common ones that you're going to see talked about. And that's just so we're going to get into a little bit of detail on each one of those, but I like that slide just because it's like a quick checklist. It's like, okay, if I have a donor, what are the possible things that I could talk with them about? So donor advised funds, this was some of our charitable organizations on the line may be a sponsor organization of a donor advised funds. A lot of community development organizations may hold donor advised funds, or there may be standalone donor advised funds, such as I know a lot of the big brokerage houses will have a donor advised fund. And this is a way that essentially what the donor advised fund is it's still a cash gift. So the cash gift still comes to you as the charitable organization, but it's a way that the donors can maximize. So if they still want to be able to take that charitable gift, they could make say a $30,000 contribution to a donor advised fund, and then they can distribute that money out over the next 4 or 5 years. They could distribute $5,000 a year for the next 6 years, and that way they get the benefit of that charitable deduction in the year that they make the contribution to the to the donor advised fund, to that sponsoring organization, and then they gradually make that distribution to the charitable organizations over a period of time. So it's still a cash gift, but it's an alternative to a cash gift as far as kind of funding it once, but then gradually making that distribution. Qualified charitable distributions from IRAs, we talked about that a little bit at the earlier part of the presentation, also referred to as a charitable IRA rollover. So depending on if you're in the financial markets or if you're more in the tax, so the qualified charitable distribution is the technical tax term for those qualified transfers from a traditional IRA to a qualified charitable organization. The requirements are here. I think most organizations are familiar with those. One of the things I did want to mention about the CARES Act is one of the provisions in there is that they are looking at temporarily waiving the required minimum distribution requirement for 2019, or excuse me, for 2020. And so I don't know how that will impact our qualified charitable distributions, because a lot of donors may be using, but maybe taking their required minimum distribution as the qualified charitable distribution, and just because they have to take the money out of their IRA anyway, they're just going to say, well, I'm just going to transfer it to the charitable organization. So I will, all this is currently developing, and so we'll kind of see how that plays out as they get the bill, once if it passes the House, and then as they get everything written. But just wanted to mention that that is something that would potentially impact the distributions, the qualified charitable distributions. There is no charitable deduction permitted for this type of a transfer from a qualified IRA to the charitable organization, but the donor also does not have to include that distribution in their income. So that's a lot of time, that's the biggest incentive, is that it helps with that income management piece. And there's things such as Medicare premiums that are driven by what their adjusted gross income is. So if a donor could keep their adjusted gross income down by using a qualified charitable distribution, there's even some outside of tax benefits that would be of interest to a potential donor. Some more of the provisions for the QCDs. Even though there is no charitable deduction permitted, the charitable substantiation rules still apply. So if you've got a donor that is giving you, or that you're getting a qualified charitable distribution from that donor, you still have to give them the substantiation back to them. And there can be no return benefit permitted, or no return benefit is permitted. So that statement on the bottom of your um, substantiation that says no goods or services are received in exchange for this gift, that better be what it says, because the donor can get no exchange on a qualified charitable distribution. And then I had a little bit of information on the Secure Act. The calculation is more technical than we have time to discuss today, but I just wanted to let people know that when the Secure Act was passed, and that was effective at the beginning of 2020, that because they basically took away the age limit on people who can make contributions to an IRA, that now impacts how their qualified charitable distributions are treated. So just be aware of that. If you haven't looked into the details already, make sure that if you are getting qualified charitable distributions from donors who may be impacted by this, make sure that you're telling them to make sure they're talking to their tax advisor. We talked a little bit about, publicly traded securities are pretty obvious. So I'm not going to spend a lot of time on those. The biggest thing that I had mentioned earlier was just the most tax advantageous publicly traded security are those that are held long-term gifts to public charities, excuse me. And so if you are a private foundation, there's a little bit of different treatment on publicly traded securities. But if it's a security that's been held more than 12 months and it's publicly traded on an exchange, and that gift is to a public charity, that's the most advantageous from a charitable gift perspective of pretty much all of the non-cash gifts that are addressed. The life insurance, there is opportunities. So if a donor has a life insurance policy that they deem that they no longer need, they may be gifting that life insurance policy to to the, they could be gifting it to a charitable organization. One of the difficulties with gifts of life insurance policies is valuing them, because it is a non-cash gift, and more than likely it's going to be a gift in excess of $5,000. Then it goes back to those 82, 83 requirements. So how do I get a qualified appraisal on a life insurance policy? And it can't be the life insurance agent who values that policy, because they are not deemed to be independent. So that's a lot of times the challenge that we see when if we have a donor who's trying to gift a life insurance policy, is how, coming up with that independent value on that policy. There's, or whether that gift is of a life insurance policy is deductible for the to the donor depends. I mean, first of all, they have to be giving up all incidents of ownership in that policy. The donor does. I mean, they can't retain any control over that policy. They can't change charitable beneficiaries. So all incidents of ownership need to be given up. Whether it's a paid up policy or if premiums are still being paid on it, that impacts the deductibility on that gift or how it is actually valued. Just changing the beneficiary deduction on a life insurance policy, even if the policy is irrevocable, is not a qualify as an income tax deduction, because they haven't given up all of those incidents of ownership. So the owner of that policy needs to become you as the charity. And so that's really the biggest piece. It's not just a beneficiary designation. So a little bit on the valuing of those policies. Depending on markets, certainly right now in the anywhere where we have charities who are in an ag environment, I'm guessing this isn't going to be something that is talked about a lot, because I think most of our producers are struggling. The commodity prices in the last few years have been low, but this isn't. But if you do have an ag producer who is interested in donating raised commodities, so your grains, etc., or livestock, there's just a couple notes here. The title to the grain or the cattle must pass to the charity. It can't be a prearranged sale where the producer just takes it to the elevator or to the livestock market and says, I want, sell my 100 head of cattle and give the proceeds to my favorite charity. The title on that needs to transfer to the charity. It's the charity who directs the sale. The benefit for the producer, even though they don't get a charitable deduction, is it's another income management piece. They don't have to include that in their tax return as well for taxable income or for self-employment tax purposes. So there are, in the right environment, and a lot of these gifts, are, we're in an environment that nothing's going to be right. Cash gifts are probably going to be the thing that everyone wants right now, and they're the easiest to give. But certainly from a plan giving perspective, and as our economy turns around, hopefully sooner rather than later, as everyone, I'm assuming, is hoping for, some of these things are good bits of knowledge to have in your arsenal for your non-cash gifts and working with your donors. Retirement account beneficiary designations. This is one that it goes back to a comment that I made earlier about understanding, if I have $1 million and I want $1 million I want to gift to charity and $1 million I want to gift to my daughter, what do I do? And retirement accounts are actually a really great gift to leave to charities, because of how the tax treatment on those distributions from the retirement accounts are treated. If I have $1 million piece of land and I can give that to my daughter. She sells it because it gets a basis step up at my death. She pays no capital gain on it. But if I give her my $1 million retirement account, she's going to pay tax on it. based on whatever the ordinary income is that is held in that retirement account. There is no basis adjustment at my death. So thinking about, okay, well, maybe I'd make the beneficiary of my retirement account my favorite charity, because the charity can take that $1 million distribution from a retirement account and pay no tax on it. So now I've given $1 million to both people and nobody pays tax because I've made tax smart decisions in my estate plan as far as what assets I want to direct to my charitable organization or to my family. Closely held business interests. These are, closely held stock, partnerships, LLC interests, S corp. My word of warning is pretty much stay away from S corp interests, and we'll talk a little bit about that in just a few minutes. But on the closely held business interests, you really have to understand the complexities of the gift before it's accepted. And then you want to weigh the compliance requirements with the reward. And so what I say when I understand the complexities of the gift before it is accepted is it going to create unrelated business taxable income? That's the biggest thing. So how is it going to change my tax reporting requirement for my charitable organization? It might seem like a straightforward partnership interest, but are there foreign holdings embedded in that then trigger foreign reporting requirements? There's a lot of things that within those, I call them the K1 investments, that you really want to understand before you accept that gift. If it's a gift of a partnership interest, are there capital call requirements within the partnership agreement? So, having a good gift acceptance policy, because if you've got a donor and you wind up saying, well, no, I'm not going to accept your gift, but if you have a gift acceptance policy as far as why you're not going to, maybe that's where some of those closely held business interests are. You don't accept that additional complexity and the additional expense of managing that gift, because you don't know, unless you're going to review the partnership agreement and you truly understand what the organization is getting in return for that gift. They can have rewards. So I'm not saying don't accept them. I'm just saying make sure you understand what you're getting before you accept it. Bargain sales are something that it's really, if I sell a property that is adjacent to my local university, and I've got property that it's highly coveted because we know that they're going to expand, or close to my local hospital, or any organization that that is looking to continue to grow. Maybe a bargain sale is something that can help. The charitable gift piece of that bargain sale could help offset the capital gain that's recognized. So you basically have to split the tax recognition between the charitable gift piece and the sale piece, but you can use your charitable gift piece to help offset the recognition on that capital gain. So the next page just has an example of what a bargain sale could potentially look like. And then we have polling question number 3.
All right. Polling question number 3 is open. Does your organization have a written gift acceptance policy? Yes or no, or what is it?
All right. So it looks like about 2/3 of our attendees today do have a written gift acceptance policy, so that's great. All right. So the last thing that we're going to talk about today in our non-cash gift world leads more to our planned giving, in that we're going to visit about split interest gifts. So when I say split interest gifts, actually some of the gifts that we already talked about could potentially be a split interest gift as well. But these are ones that there is a non-charitable interest. And when I mean non-charitable interest, that's an individual. That is either the donor or someone the donor has designated, whether it's a son, daughter, it's a non-charitable beneficiary. So there's a non-charitable interest in the gift, and there's a charitable interest in the gift. Whether that charitable interest is first or comes later in life depends on the gift. And we'll kind of see those. Charitable gift annuities, so these are really just think about these as how a normal annuity would work, except it's involving you as the charitable organization. So the donor makes a contribution for the charitable gift annuity to you as the charitable organization. And in exchange for that $1 million transfer to my charitable organization, I'm going to give the donor back an annuity over their lifetime, over 2 lifetimes, so it can be joint or the donor and the donor spouse. So there's a few different terms that can be there. Um, so on a charitable gift annuity, typically the rate of return, if you want to call it, on those are not as high as a commercial annuity, because there is intended to be a charitable element to that annuity. So I'm not going to pay out what the normal commercial rates are paying, because there is some residue at the end of that annuity that is intended to go to the charitable organization. Charitable gift annuities can be secured by by the assets of you as the charitable organization, or you can choose to have them reinsured through a commercial annuity. And so, but that's up to each organization's decision. Larger organizations may have these complex charitable gift annuities. I say they're complex just because there is some administration that goes into them over the lifetime of that annuity. And certainly by volume, the more beneficiaries that you have of those charitable gift annuities, the more complex it is to manage those. But so the first example of that split interest is that I give $1 million to my charity, but the charity turns around and gives me an income stream back based on my life expectancy. And so, but the intent would be that when I die, there's residue left over, and then that becomes the asset of the charitable organization. Just an example, just a visual example of how the charitable gift annuities work. Reasons why charitable gift annuities may be beneficial. Potential risks for charitable gift annuities is that because that money that I gave to fund that annuity is now property of the charity, and it's subject to the charity's other creditors, unless it's reinsured through a commercial entity, is that if my charity goes into financial dire straits, then I don't get my income stream back out. My risk of loss is the same as all of their other creditors are. And I also can't change my charitable beneficiary. So once I give that money to you as the charitable organization, I can't take that back. So it's not a risk to you, but it's certainly a risk to the donor, that if they decided in the future that they wanted to split their gift and give it to the American Cancer Society as well as to your organization, I can't do that. I've made that decision that your organization gets my money. Charitable trusts, charitable remainder trusts, and charitable lead trusts. Those are, I would say, probably the most commonly known split interest gifts, but the most compliance burdensome gifts to give. They require, it is a trust, so it requires an attorney to be involved, a knowledgeable attorney who understands the complexities of charitable trusts, and so that they are worded appropriately as far as what the limitations are for the distributions, the distribution or the period of the term. So if it is, for example, a charitable remainder trust, if you set it for a period of years, it can't be more than 20 years. However, it could be over someone's life expectancy, which could potentially be more than 20 years. But if it's a life expectancy, that's one thing, but I can't say I want the trust to last 25 years. It can only be up to 20 years. The charitable trust can be both inter vivos trusts or testamentary. So what that means is I can establish those trusts while I'm living, or I can establish those trusts as part of my will or other testamentary determination. So if it's their trust agreement after my death, they can be both living gifts or upon my death, those trusts can be funded. A remainder trust is the remainder goes to the charitable organization. So after my life, the remainder of that trust balance goes to the charitable organization. And the opposite is the lead trust. The charitable beneficiary is the lead interest, the first interest in that trust. Each one, obviously each one, you're going to want a donor that has some charitable intent. The low basis, highly appreciated assets always work well. But the biggest thing is the income piece of it. There are so many different ways that the charitable trust could be structured. You could structure it so that it can be an annuity trust, which is a fixed payment amount. So I'm going to establish a charitable remainder trust. Me as the income beneficiary is going to get a fixed dollar amount every year for the next 20 years because that's the term of my trust. And at the end of the 20 years, the remainder goes to the charity. There's unit trusts. So there's both lead unit trusts and remainder unit trusts. The distribution amounts to the non-charitable beneficiaries or to the charitable beneficiaries, whoever the income stream is getting, varies based on the fair market value of the underlying assets. So you don't necessarily want to put hard to value assets in a unit trust because the donor is going to have to, or the trustee is going to have an appraisal done or evaluation done on those assets every year, which can be expensive to revalue those assets. So a lot of times if you're going to put harder to value assets, we typically see those maybe as an annuity trust because you set the distribution at the beginning and then those, you don't have to revalue those every year. There are split charitable trusts that can be based on, they're based on net income. So there can be a net income charitable remainder unit trust or a net income makeup, so a NIMCRET or a NICRET. Those are a couple hybrids of the charitable remainder unit trust. There can be, and those are actually the net income trust might be a situation that if a person has a bunch of, they have $15 million in farmland and it's low basis, but it's going to be harder to sell. But I'm going to fund my trust with that farmland. And because there's no income being generated, or if there is no income being generated, and I fund it as a net income remainder unit trust, there's no distributions in the year that there's no income. But in 2 years, we finally get the trustee finally gets the land sold. Now you've got several $1 million that's being held in this charitable remainder trust. And then the distributions start coming out and it becomes tax advantageous to, because that recognized, that deferral of that capital gain is recognized as the distributions are made from the trust, and rather than selling all of that land at one time. So they're definitely more complex, but there's situations where they do work really well. They also have separate tax filing requirements. So I mentioned the initial expense for the legal counsel to get those trust documents drafted appropriately. There's also the 5227s, the tax return that's required for those split interest trusts. So that becomes part of the administrative burden on those. They're also treated as the same as private foundations are. So they've got very stringent operating restrictions as far as from a donor's perspective. What control can they have, what assets can be held in those, so you're not violating any of the private foundation compliance elements as well. Just in a visual of kind of how the charitable remainder trust works. And another visual, like I said, a lot of these are, we talked about the terms, not more than 20 years or for the designated beneficiary's life. Assets to use when funding a split interest trust is, those are good assets to have. The appreciated unencumbered real estate. So when we say unencumbered, that means no debt, because if there's debt, that can cause unrelated business taxable income. Retirement plan assets are good because as we talked about before, there's no basis step up when the donor dies. So they're advantageous from that perspective. We talked about the farm property that has low basis, life insurance policies as well. Assets to avoid when funding a CRUT. These are typically the more difficult non-cash gifts anyway. So if you have someone that's talking about funding a split interest trust, certainly want to think about how they're funding them, and hopefully their tax advisor is doing that first and foremost. But if you are having philanthropic discussions with some of your clients, and they're depending on the assets that they're holding, especially if they're a closely held business owner, if they're looking at putting business property in there, make sure that you've got a really good understanding, or that you're recommending that they talk to their tax advisor to have a really good understanding of what potential tax implications and pros and cons that there would be of funding that. Charitable remainder trusts are not tax free. They are tax deferred, and there's a very specific order in which the income is taxed to the non-charitable beneficiary. So that's part of the complexity of those trusts. And life estates. So life estates are if I have, again, farm or say a personal residence, and so life estate of my personal residence would be, I have a residence that, and especially for someone who is maybe, older more advanced in their life, I say I'm 85 years old and I'm still living at home, but I have sufficient other assets that if I need to go into long-term care, I have sufficient assets that it's going to cover that. But I have a residence. And so maybe I'm going to give my house to my charity. The charity's going to let me live there until I either die or till I need to go to a nursing home. And it would, at that point, then the charity can do with what they want. So it's a split interest gift. While there is no monetary exchange, it's that right to live there. It's that partial interest that I'm allowed to stay in my residence for my lifetime, knowing that at the end of my life, then the charity, they have the right to sell that property or convert it to part of their campus or whatever they need to do. But that is another, it's a retained interest gift or a partial interest gift that I've seen a few of. And we've got our final polling question. All right, and it's happy birthday today. So as I was trying to come up with my polling questions, I was like, okay, well, I want to do something a little bit fun. But then all it did was made me feel old because it's happy birthday today, happy 60th birthday to Jennifer Grey. So for those from that Dirty Dancing was one of their favorite movies growing up, yeah, I was feeling old today too. Actually, all four of those people are celebrating 60th birthdays in 2020, so happy birthday eventually to all of them. But yeah, it was, so that was my trivia for today. But in summary, charitable planning, as most of you know, as I looked at the first poll, or the poll on how many of you have internal development staff or philanthropic planning staff, you know that planning can be complicated. So it goes back to that comment before about or that slide before about convening the team, because you're not, your staff are meant to be developing the donor relationships and to helping you build your financial needs within your organizations, and rely on the resources that are out there too to help with that, because it is complicated. You're not expected to be a tax advisor. I'm certainly not a marketing person. I will never be a marketing person. So development, we can each bring those resources to the table to help find a successful gift for the donor and help them meet their charitable intentions, and really have the win-win for everyone. So with that, I do see some questions. So
All right, there is one question in the chat here. It says, what happens if the owner goes into a home and they have given their residence to a charity with a life estate?
I'm actually going to double check on that one, because I want to say there's going to be some long-term care state issues, and as far as the ownership on that property versus what, if they have sufficient assets outside, it's not going to matter. But I think the biggest thing is if they have Medicaid, if they're taking any kind of state assistance, we would certainly want to take a look at that as far as, so I could, if you want to keep that question, Amy, I'll do some research and get back on that one. So it says, you indicated that it's substantiating a gift, not to declare value. That's correct. However, in acknowledging a gift, are we allowed to indicate what the donor has indicated as the declared value, or is it best to not have any value noted at all? And then, is the charitable organization responsible for declining a gift if it is valued more than $5,000 and does not have a professional appraisal? Okay, first part of that question is, it is best not to indicate a declared value at all. So if you are substantiating a non-cash gift, thank you for your gift of 100 shares of ABC stock on March 26th, 2020. No goods and services were received in exchange for your gift. Or thank you for your gift of a quarter of land, legal description, or thank you for your gift of whatever. That's all you should substantiate in that charitable, the substantiation of the gift back to the donor. So it is the donor's responsibility for substantiating what they're considering to be declared value does not and should not be included in your gift. Because if you are stating something in your letter, you are essentially confirming its value, and because you are not an appraiser, there's nothing in the IRS requirements that would require you to include a value in that gift, and therefore you should not be, because you are not the appraiser. And then, so that goes into your second question, is if the charitable organization responsible for declining a gift. So you don't have to decline the gift. You could accept the gift if it's within your gift acceptance policy, if you have one, but it's up to the donor to obtain the qualified appraisal to substantiate the value of their non-cash gift on their tax return. And there are certain situations where the donor has to just obtain the appraisal and then keep it for their records. There are also situations where the donor has to obtain the appraisal and submit the appraisal to the IRS with their tax return. So whether or not they have a professional appraisal isn't the charitable organization's responsibility. All you're responsible to do is just to substantiate that yes, you received the gift, and if you are to sell that gift and within a certain period of time, that you will complete 8282. But as far as them getting the appraisal, that's between them, their tax advisor, and filing with the IRS.
I know there was quite a few questions on here. Would you like me to pull the report and we can answer the rest offline since we're over time?
Sure, because there was only 2 that showed up for me. The rest of them, I
Okay.
think, were just like audio issues. But yeah, absolutely.
Okay.
I'm happy to respond back. So
Sounds good. Okay, everyone. So if you did submit a question, we will get those answered offline. The recording of this will be ready in about 7 days. And then we'll send that link out to everyone, and I will send out the handouts this afternoon. So thank you to everyone that attended, and thank you to Melissa, and I hope everyone has a great day.